Hey everyone, and welcome back to the channel. Have you ever looked at a trading chart and just felt completely overwhelmed by all those little red and green bars? They're called candlesticks, and they might seem like some secret code that only Wall Street pros can understand. But I promise you, by the end of this video, you'll be able to read them like a book. I'm going to give you the simplest, most straightforward guide to understanding candlesticks, and it's going to completely change the way you see the market. Forget those complicated books and confusing tutorials. We're going to break it down into easy, bite-sized pieces so you can start trading with more confidence today. So, grab a coffee, get comfortable, and let's dive right in. First things first, what is a candlestick actually showing us? It might look like just a simple shape, but each candle tells a complete story about what happened in the market during a specific time period, whether that's 1 minute, 1 hour, or 1 day. Every single candle gives you for key pieces of information. These are the open, the close, the high, and the low. The open is the price where trading began for that period. The close is the price where it ended. The high is the absolute highest point the price reached, and the low is the absolute lowest point it touched. The main rectangular part of the candle is called the body. It shows you the range between the open and close price. Those thin lines sticking out the top and bottom are called wicks or shadows. They show you the full range from the high to the low. So, in one single glance, you get the entire story of the price action. It's not just random data, it's a visual narrative of the battle between buyers and sellers. Now, let's talk about color. You'll typically see green and red candles, although some platforms use white and black. The concept is the same. This is how we instantly know who won the battle for that time period, the buyers or the sellers. A green candle is a bullish candle. Bullish means prices are going up. A green candle forms when the closing price is higher than the opening price. This tells us that during this period, the buyers were in control. They were more aggressive, pushing the price up from where it started. Think of it as a victory for the bulls. On the other side, we have the red candle, which is a bearish candle. Bearish means prices are going down. A red candle forms when the closing price is lower than the opening price. This shows us that the sellers dominated. They pushed the price down, and the bears won the round. It's that simple. Green means buyers won, and the price went up. Red means sellers won, and the price went down. Just by looking at the color, you get an immediate sense of the market sentiment. Okay, so we know what a candle shows and what the colors mean. Now for the fun part, the shapes. There are dozens of candlestick patterns out there with fancy names, but honestly, you don't need to memorize them all. It's just not necessary and can lead to analysis paralysis. Instead, let's focus on the 3 most important and powerful patterns that truly matter. First up is the pin bar. A pin bar has a long wick and a small body at one end. A long wick sticking up means sellers rejected higher prices, which is a bearish sign. A long wick sticking down means buyers rejected lower prices, which is a bullish sign. It signals a strong rejection of a certain price level. Next, we have the engulfing candle. This is a large candle that completely engulfs the body of the previous candle. A bullish engulfing candle is a big green candle that swallows the prior red candle, signaling a powerful shift to buying momentum. A bearish engulfing candle is the opposite of big red candle swallowing a green one, signaling a shift to selling pressure. Finally, there's the doji. A doji has a very small, almost non-existent body, with the open and close prices being nearly the same. It looks like a plus sign or a cross. This pattern signals indecision. Neither buyers nor sellers could take control. It often appears before a major market reversal. Master these 3 and you'll be way ahead of the game. Now, this is probably the most important lesson in this entire video, so please listen closely. The patterns themselves don't mean much in isolation. Context is everything. It's not about what the pattern is, but where it appears on the chart. Think about it. A bullish pin bar showing rejection of lower prices is incredibly powerful if it appears at a key support level. It's a clear signal that buyers are stepping in to defend that price. But that same pin bar appearing in the middle of a random price range with no significant levels nearby, it means practically nothing. It's just noise. A bearish engulfing candle at a strong resistance level is a high probability signal that the price might reverse downwards. But if it shows up in the middle of nowhere, it could easily be a false signal. You must always analyze candlesticks in the context of the overall market structure. Look for them at key support and resistance levels, trend lines, or moving averages. This is the secret to using candlesticks effectively. Location, location, location. A pattern is only as good as where you find it. So there you have it. You now know the 4 key data points in every candle, how to tell if buyers or sellers are in control, the 3 most important patterns to watch for, and the golden rule of always considering context. You can officially read candlesticks and understand the story the market is telling you. This isn't some magic trick, it's a skill. And like any skill, the more you practice reading charts, the more intuitive it will become. Pull up a chart right now and see if you can spot some pin bars, engulfing candles, and dojis at key levels. I guarantee the market will start to make a lot more sense. I hope this simple guide has helped you feel more confident. We'll be back with more simple trading lessons to help you on your journey very soon. If you found this helpful, a like and subscribe would be amazing. Thanks for watching, and I'll see you in the next video.